Hello, I'm Katie Greifeld. I am a reporter and anchor for Bloomberg News. I'm thrilled to be joined by Fate Saghir. She is SVP and Head of Sustainability at Mackenzie Investments, and Martin Grosskopf. He is Vice President and Portfolio Manager, Sustainable Investing at AGF Investments. And today we're going to talk about ESG and ETFs eligibility. And guys, I want to start right there. I cover ETFs. And when I think about ESG and sustainable investing, I often wonder whether ETFs are the best vehicle to actually make those investments. Because a lot of people, when they think ETFs, they think broad, index-based, not necessarily specific portfolios. So Fate, I want to go to you first on whether you consider ETFs really as the vehicle of choice to make some of your investments.
Sure. Great question. And thank you for having me today. Yeah, of course. I think there's a couple of different nuances, right? You have in the Canadian market, you have quite a number of ETFs that are actively managed. So those kind of, and often in the market, you'll find that they'll have their mutual fund counterpart also available to investors. On the passive side, I think, we're seeing it happen in the US, and I hope it starts to translate into Canada, but you're starting to see index providers come out with, you'll have your parent index, and then you'll have the ESG counter. And so I think it is a good vehicle. And I want to just clarify, when we're talking about ESG, there's a couple of nuances, which, until today, we haven't really figured out, and we have a lot of work to do to clarify for investors and to clarify for the industry. But you have the ESG parts of the equation that are focused on how corporations and governments behave. And that's, I think, how traditionally we talk about ESG. But you also have the kind of, let's call it, more thematic stream that is quite popular in the ETF space, which is really about the products and services that companies bring forward, right? And how sustainable those products and services are in building a better future for all of us. So I most definitely think the ETF could be a choice, but I think those nuances between how companies behave and the products and services that are brought forward are really important for investors.
And Martin, I want to get your take on that. But before we move on, Fate, quickly, you mentioned that there's a lot of active ESG ETFs in Canada. When you are evaluating, do you tend to gravitate towards those active funds over some of the passive options out there?
Yeah, I mean, we're an active manager, Mackenzie Investments, so we like active investments. I think what happens there is you just, the portfolio managers end up having more flexibility, right? Putting kind of their view of the world on how money is managed with an index-based ETF. Sometimes you have to work through the index provider, so there's a bit more nuance there.
Okay, fair enough. And Martin, would love to hear your thoughts on whether, when you're making ESG or sustainable investments, whether ETFs really check all the boxes in terms of vehicles.
Yeah, thanks very much for the question, and pleasure to be here today. Certainly as a portfolio manager, I mean, I think we're largely interested in getting our strategies out to as many investors as possible. And so I think the wonderful thing about ETFs is, there's a democratization there. It's available to the average investor. And, the type of strategy that I manage wasn't available, other than through an advisor or through a foundation endowment type investment or a pension fund. And so I think that's a big benefit. And as was noted in the prior comments, we do run an active strategy. It's certainly off benchmark. And I think there's no reason why an ETF structure can't be beneficial from that regard.
And when I look at both of your bios, I see sustainability, I see sustainable investing. And I feel like, at least in my world, people can get a little bit lazy and use ESG and sustainability as interchangeable terms. And I would just love to hear your guys' perspective on whether that's a proper thing to do or whether there needs to be more nuance there. Martin, I'd love to start with you.
Yeah, that's you're right into the tricky question there. I think it's something that the industry's trying to figure out. Regulators are trying to figure out. Terminology is a big issue. I kind of go back to before I joined the industry. I mean, my background was sort of in environmental consulting. So the background was around sustainability at the time. There was no terminology around ESG in the financial markets. That kind of started around 2003, 2004. For me, it's always been about, directionality, about trying to make more sustainable choices. That being said, I think ESG now is so broadly adopted, it can mean almost anything to anybody. And that's why I tend to use the term sustainable, because, when we're making investments, it's really in companies that we think are providing some kind of solution to a particular sustainability issue. ESG is often used broadly as a risk framework. You can find, any kind of company in an ESG portfolio. And that's what regulators are somewhat concerned about, that has been taken that broadly. And so I think, there is a distinction in my mind. It's not always made clear by the industry or even by participants.
And we're definitely going to get into how regulators are approaching this. But Fate, would love to hear your thoughts on sort of the terminology issues here.
Yeah, I completely agree with Martin. I think it's a work in progress globally, not just in Canada. And I agree. I think sustainability is about intentionality and making those the right choices. But within, we think about ESG like really they're just a number. It's the same as when you're looking at your financials, right? I think of them as building blocks, right? Or they're really a bunch of factors. And really what you look for from a portfolio manager or an ETF that's being constructed is which components of ESG are most important, and how are those being brought together to build out sustainability outcomes, right? So I think of them as building blocks. We actually in our company, anyone that meets with me knows not to use the term ESG investing because I have a bit of a visceral reaction to it. So I think sustainability is what we should all aim to achieve.
Well, Fate, to that point, when you think about ESG, and I don't want to trigger you, but the fact that there are those three buckets, which if you put them into a Venn diagram, the E, the S, the G, there might not be a lot of overlap there. So is it possible to satisfy all three buckets, or are there always going to be some sort of trade-offs?
Yeah, that's a great question. And I think, again, that depends on the product design. But, when you think of, so you're thinking of the E, the S, and the G, but really when we think about sustainable development and the true definition of sustainable development, it's about the people, it's about your environment and the planet and the economics and the profits you're able to generate. And yeah, there will need to be trade-offs, right, to achieve kind of that perfect harmony. But I think that's it's up to the portfolio managers managing the money or the product team that's pulling together the ETF and what trade-offs they're willing to make. I think the core here is being transparent. And explaining to the extent that you're able to how these products are coming together and on what trade-offs you are having to make, right? Which today I think disclosures are still a little bit lacking, but I know in the Canadian context we're all actively working on those with the regulators.
And Martin, no one's perfect, no company is perfect, no portfolio is perfect, but how do you approach the topic of trade-offs?
Yeah, I think the more clear they are and the more honest you are about them, I think the better. I mean, there's no doubt that, there's been a bit of a sell going on in the ESG community over 20 years. Let's face it, we've tried to make these issues important in a mainstream financial community that certainly viewed them as something that was not part of their day job as fiduciaries. That's changed. And in the process, though, I think we have lost a little bit of the reality around trade-offs. And, there's a certain point where investing in diversity in a firm, investing in environmental management in a firm may be margin detractive in the short term. Those are the kinds of discussions you need to be having. And as shareholders, we want to be having those discussions with companies. It's not always a win-win in the short term. Sometimes you're making an investment for the very long term that could, as I mentioned, it could cause issues in the near term for something like cash flow. So we need to be aware of those and really open about them.
And when those questions do arise, how do you approach those conversations? Do you just make that point about timeframes, that this is a short-term trade-off?
Yeah, I think, when you're talking about a 2050 commitment, that's a horizon, that's a duration in the market that really has, I don't think there's any historical precedent, right? There's no time in history where a firm or a shareholder would say, I want you to invest now for something that, is preparing you for 2050. So that level of duration, to keep your eye on the ball longer term, I think you need to be able to support a company through an investment phase, whether it's anything we've been talking about, solar, wind, hydrogen, hydroelectric, energy efficiency, sustainable food practices. Now's the time to invest. You're going to reap the benefits over time, but, will it be a benefit in your next quarter? Probably not. Your CapEx intensity is going up, and yet, rates are going up. That's not the best dynamic, for a firm. And yet we have to look through that as shareholders.
And it feels like in that rising rate environment, the attention span has gotten even shorter. But Fate, Martin used a really interesting phrase, which is investing in. And when people think about ESG, when they think about sustainability, investing, I feel like a shorthand is often excluding certain types of companies. What are your thoughts on that?
Yeah, I think in the Canadian context, I think exclusions are, we approach them very cautiously, right? We have a resource intensive economy. And I know even some global asset managers that participate in Canada tend not to apply the same level of exclusions in Canada that they might globally. And specifically along the when we're thinking fossil fuels, right? We're very cautious of that. We have such a great dependency on them. So what you'll find in Canada, and we do, we ourselves, and I know Martin's organization as well, we're members of the RIA, and so we publish annual, and we're moving into annual trends studies. And you'll find in Canada there's a big focus on ESG integration, which Martin touched on a little bit in terms of using ESG as a risk framework. That's really important in the Canadian context. You'll find there's not as much of the exclusionary type strategies or policies. And then we do focus on engagement. So for us, it's really important. Then this is where the active management is very important. When we're managing a fund, it's important that we're spending time with some of the sectors where we feel that, 10, 20, 30 years from now, the products that you're bringing forward may no longer be relevant. And so what are you going to do to transition your business operations, your workforce, and so forth. So I think you'll find there's less focus on exclusions and more so on let's integrate the risk. What risks do I see? And then when you do see risks, how do you ensure that you're working with those companies to move them forward?
When we're talking about fossil fuels, in the same way that it's probably important to couch this conversation in this rising rate environment, one of the products of that is that energy companies have just been outperforming the market massively this year. And sort of to the point that Martin made, that if you're thinking about the long term, that's what to focus on. The short term, it might be a negative hit next quarter, for example. But when you're engaging with these companies, what are those conversations sounding like, especially when you consider the performance backdrop?
Yeah, I mean, for us, we're a Canadian asset manager. This is the country that we belong to, and so we approach it with a Canadian lens. We talk about what I don't think any of the companies that we work with or any of the companies that we've invested in, I don't think anyone doesn't believe that climate change is real and it's coming. And I don't believe that we don't hear any hesitancy as to what transition. I think there is a sense of collaboration and us coming together with Canadian companies in the energy sectors and other carbon intensive sectors to say, okay, what are you doing? And we try to bring the global perspective. So what's happening in Europe? Can you get investors from Europe? What's happening in the US? What's happening in Asia? Just to give them a sense of, we're not operating in a silo here. There's a globe around us, right? And we need to participate in this. So I think our conversations have been very positive. We've had a couple of companies that we've engaged with more recently are working through their TCFD reporting and so on. So I see that, we approach it as a Canadian asset manager, and as such, I think we're getting really good responses.
And I promised that we would get to regulators, and we have a little less than 5 minutes left. So I want to make sure we get to this topic. We have to talk about greenwashing because DWS's group's Frankfurt office, of course, were raided in May following accusations of greenwashing, basically mislabeling to the terminology discussion we were having earlier. But Martin, I'll start with you. In the aftermath of some of these high profile greenwashing allegations, has that changed your process at all, how you approach potential investments?
It hasn't really changed what we do because I think we were, quite early in developing a very strong process around sustainability. And so I think any of the standards that we're seeing emerge, we're quite happy to sort of jump through the hoops that are going to be set. That being said, there's regional differences. There's a pretty significant difference between what's being asked in the EU and what might come through the SEC in their proposals. So it does provide some challenges in terms of, where to focus and how to communicate. And if there's some process enhancement that's needed, which market, are you going to focus on? And so that is definitely a bit of a challenge because regions have different objectives, in terms of what they're trying to accomplish, and nations have different objectives. It would be nice if there was just one global standard around, what a sustainability fund should look like. That's not the case today. And so, we're going to be dealing with a diversity of approaches. And for us, I think, it's a challenge, yet it's something we're prepared for. We think we're going to come through quite well through any regulatory requirement. But that's not to diminish the fact that it's an increased focus for the team, for sure.
Mm-hmm. And Fate, same question. I mean, have your processes changed at all? Any sort of rethink in the aftermath of DWS and other greenwashing allegations?
Yeah, just maybe more documentation. And I'd say to Martin's points on our sustainable investment funds and ETFs, where in the investment objective, it's very clear that this has a sustainability intention or outcome. I think we've always kind of had the added layer of oversight on those types of products. Where we had to do a little bit more work and just ensure that we've got all of our documentation in place, where we talk about using ESG from a risk component. So and on every other fund where we expect our PMs to identify material ESG risks and address them in their investment process in one by one approach or another. That's where we had to go back and just make sure our PMs had their the right write-ups, and that if we were audited, and now my own team is doing auditing on all our investment practices, to ensure if a regulator did come, that we had everything, we can deliver a package. I think that's where we had to do a little bit more work, and the Canadian regulator has asked that if any fund that does take ESG into consideration, that you lay that out in the investment strategy of the prospectus documents. So most of the asset managers in Canada, I believe now you'll see have that added layer of disclosure. That's where we saw a little bit more work, but I think on the sustainable or ESG labeled funds, we were pretty set.
All right, guys, we've got a minute left. I want to end on an optimistic note. In 15 seconds to both of you, where do you see the most opportunity right now? Fate, I'll start with you.
I see opportunity in net zero and climate action. I think, Martin talked to the 2050 timeline. And yes, it's a long time away, but it's really not that long away when you think about the CapEx changes that need to take place over the next 20 to 30 years. So climate action and net zero is where the kind of our priority.
Martin, 15 seconds. Where's the biggest opportunity?
Yeah, well, I mean, I certainly agree with those comments. I take it, I guess, the opposite side. We're in climate change. It's not something that's going to happen in years out. It's happening now. So we're putting quite a bit of investment into companies that are helping regions adapt, flood, drought, fire risk. Those are areas that are absolutely front and center.
All right, guys. Thank you both so much. That was great.